I think the Fed is raising rates quickly, which is the tool they have, and also telling people what they're doing and being transparent. And if you start to see some adjustments being made, the rate of increase in certain areas has tipped over a little bit, but there's still work to do. In the end of the day, the Fed's toughest job is the fact that it's trying to slow down an economy which has strong employment, strong wage growth, and strong spending. And that's not the usual. That's an unusual case to see all that go on at once. And by the way, with the U.S. being one of the strongest economies in the world, and so I think they've got a tough job ahead of them. But they're using the tools they have, which is to basically raise rates and change the balance sheet. But more important, to tell people what they're doing, and you're seeing the markets adjust to that.
Brian, you have so many ways at Bank of America of looking into the U.S. economy, getting a sense of where it really is. One of the big questions is, do we think inflation has peaked? If you were asked that question, what would you say?
Well, I think it'd be different for different areas. So you're seeing in some areas the rate of increase slow down and starting to tip over, but you're seeing other areas, wage growth is still very strong. So I don't think it's peaked yet. And our economists would say it's peaking probably is our team. Our team basically says that the Fed will continue to raise rates. And actually, Candace Browning-Platin's team, the research team at Bank of America, has the year-end recession, which they made a call on a few weeks ago. But it's a slight recession, and a recession is not accompanied by high unemployment, which means it ought to right itself and come back out. But it's more the impact of the Fed raising rates and slowing economy. So it's peaking is probably more appropriate than peaked. You're seeing some indicia that's starting to tip over in areas and flatten out. And remember, the way the economists think about it, it's not the $100 to $115 price change. It's the 115 as it looks forward. And I think the expectations are starting to flatten a little bit of future inflation as you hear them come through.
Flat is one thing when it comes to inflation, down is another. And one of the questions is, even when we've peaked and start to come down, how fast is it likely will come down? Forget about the end of 2022. What about the end of 2023? What does your team, Candace and the others, say about where they think inflation will be at the end of 2023?
Well, they think the recession, then inflation will calm down. And by the end of 23, you're starting to work your way back up to the 2% type of growth rate in the United States. I think they have 1% toward the end of 23, if I remember right, but still under trend growth. And so it's still recovering. And so that means that they see inflation having tipped over enough that the Fed then pulls back on rates a little bit. So their rate structure, the Fed funds rate actually comes back down a hair towards the end of next year, but it's relatively the same.
Well, Brian, as a practical matter, different economists say different things. Do we need to get federal funds rate significantly above the rate of inflation in order to really get inflation under control? Do we need a positive real yield?
Well, that's what the economists would say to change the dynamic of going on. But I think a lot of this is all different. And David, as we look in our customer bases, it's just a different time. And everybody says this time is different and all the things that go on in life, but it really is unusual to have the consumers have the amount of money they have to spend still in their accounts, to be spending at the level they're spending above the rate of inflation, and have wage growth and unemployment so low. I think it's just different because in prior economic changes, there wasn't the type of new job destruction, lack of new jobs going on. And, new claims for unemployment are still 230,000 on a weekly basis. They were like 300,000 to 400,000 before the last recession. That difference is also on a probably 15, 20% larger workforce. So a lot of statistics that are relevant in the past just aren't relevant because the amount of stimulus went on, the unusualness of the pandemic, the Russia invasion of Ukraine. These are circumstances which the typical ebbs and flows of economic debate don't take into account. So I think a lot of it has to be thought through really in a hand-to-hand combat, day-to-day combat. What's going on? What's the data say? What's going on, as opposed to some theoretical construct. And that's where the economists are struggling, because it really is different in terms of what got us here was a pandemic. The economy was moving along fine, and what got us here was a pandemic. And what got us out of it was huge stimulus by the administrations and Congress and monetary accommodations around the world. And now we're just having to correct that and pull it back out of the system to let the economy get back to normal, driven by the free market and things like that.
So, Brian, how does this affect Bank of America? You had earnings out earlier this week, strong earnings, I think everyone would agree on, particularly when it comes to things like deposits and lending. How is the way you look at this economy, with some of the conflicting data points, actually, you suggest, how is it affecting Bank of America?
Well, We had a good second quarter, earned 73 cents a share. Had loan growth, had deposit growth. Deposits were down year over year. They grew. Year over year loans grew $120 billion. Year over year deposits grew. But the core thing that we're doing at Bank of America is the organic growth engine is kicked back in. So we are selling in the consumer franchise the same number of products across all this wonderful customer base we have as we did pre-pandemic. In the wealth management franchise, I think we had 6,000 new customers in the quarter. In the commercial franchises, the loan growth was very strong, 5 or 6% nominal rate, annualizing 20% growth rate in the quarter. And so we feel good about the organic growth engine. It's back in the work we do with our local market teams, working together in markets to get business. That's all. And so we feel good about that. The second thing we feel good about is credit quality is very strong still. So our charge-offs went up a little bit, but most of it was due to unfundamental stuff. We sold some loans, and just how the accounting works. We made a gain one place and took it through the charge-off to offset it. Those types of things. But basically, charge-offs are in very good credits in very good shape. Charge-offs are low. The consumers about half of what they were pre-pandemic in terms of quarterly rate of charge-offs, 900 to 500 type of numbers. So that's in good shape. And then the major thing we have is operating leverage. Our revenue is growing faster than our expenses for the fourth quarter in a row. We had 5 years of that before the pandemic. The pandemic obviously changed that around. But we got expenses, revenue grew at 6% year over year. Expenses grew at 1.5% or so. And that's 4.5% operating leverage. In our big platform, that's a lot of profit. So what we call our PPNR, pre-profit without taking the credit, because we had a big reserve release last year, was up 20% year over 15% year over year, which is very strong. And that means the core business is operating well.
So let's take each of those three in turn, if we could. Number one is the volume of your business. You also have increasing rates, which you've always said benefits Bank of America, given the nature of your business. We saw it in net interest income, for example. Do you see that continuing through the end of this year and maybe even the next year, given where the Fed is likely to be headed?
Well, one of the things, I've been CEO, this is my 13th year, and almost all that time has been a artificially low rate environment due to the need to stimulate the economy, to try to correct the excesses that built up in the 2000 to 2007 area that came to the financial crisis worldwide, et cetera, et cetera. So we finally got rates up, and then the pandemic hit and forced another major adjustment and accommodation. So as rates rise, our company, because we have a huge amount of non-interest bearing checking transactional deposits in our consumer business, wealth management business, our corporate commercial businesses, we have a huge amount of that, and that is a zero interest. It's the way it works, because the money is in motion at all times, but the collective balances work. So we benefit by higher rates. To make it simple, I think year over year we're up almost $2 billion in NII, from 10 to 12 billion round numbers. We told people for the third quarter we should be up 900-ish million over last quarter. Same, and then we said potentially even more for the fourth quarter. I think we said 900 billion for third quarter, potentially more. So the NII is growing, and that's because the rates are lifting off of floors where, frankly, our industry and our company were subsidizing the customer because we didn't take rates below zero. In other parts of the world, they do that, but we don't do that. We didn't do that in the United States. Therefore, as the rates came down, you hit a floor. And as the rates go back up, that floor doesn't move, and you start to get the profitability back in the industry.